Which stocks should be on your Christmas list? We'll tell you in this video, and we'll explain why. But first, where are we?
The North Pole, fool.
Mrs. Claus? Are you day trading?
Well, how do you think we pay for all these toys?
I never considered that. Now consider this. When you invest, you're generally hoping for a good return on investment.
Well, amen.
So in the stock market, wouldn't it be helpful to invest in companies that are good at generating a return on the money they invest? And in stock market language, they call that return on invested capital.
Well, the old guy loves that ratio.
Do you mean Santa?
No, you idiot. Warren Buffett.
Ah, yes, Warren Buffett does like the return on invested capital ratio. And just as an example, say a company put $100 of capital to work and generated $1 of profit from that. Would that be a good return on invested capital?
Listen, Johnny boy, if you were the CEO of that company, I'd fire you faster than Santa could slide down a chimney.
Tough, Mrs. Claus, but true. 1% as a return on invested capital ratio is pretty brutal. A lot of people say 10% is pretty good, 15% is even better. And for our list of stocks today, we looked for companies that generate a return on invested capital of more than 25%.
I like what you're throwing down.
Right? And since some years can be better than others for companies, we wanted to have a list of stocks that had return on invested capital ratios of more than 25% for at least the majority of the past 5 years. So, which stocks are on our list?
Keep your pants on, Romeo.
What?
You can't just look at return on invested capital without looking at the weighted average cost of capital.
That's true.
Well, of course it's true, Einstein. Businesses have to consider the cost of debt or equity they're using as capital to finance their business. Because if it's higher than their return on invested capital, they're destroying value.
Right, so the return on invested capital has to be greater than the weighted average cost of capital. And for our list of stocks, we wanted not just companies that could meet that threshold, but we're doing so by at least 3 times as much. In the capital allocation world, that's what they call crushing it.
Well, Johnny boy, I'm gonna call you boring if you don't get to that list of stocks soon.
Noted, Mrs. Claus. Just a couple more things before we get to our list of stocks for consideration for your Christmas list. Number 1, this group of stocks had to be recommended by a majority of the analysts who cover them on Wall Street, so that further narrowed the list. And number 2, because the majority of these stocks have price to earnings ratios that are higher than the S&P 500 on average, we looked at something else. We looked at companies that are expected to see a meaningful increase in their free cash flow over the next 3 years, because we figured if these companies have a history of being good allocators of capital, at least in that case, they would have a good amount of cash to work with in the years ahead.
Are you confident they will?
Well, look, nobody knows the future, but yes, based on the average analyst estimates, there is a belief on Wall Street that these companies will see their free cash flow increasing over the next 3 years.
Ah, okay. Well, thanks for clarifying. But if you take any longer to get to this stock list, I'm gonna take this elf here and shove it up your...
No need to get violent, Mrs. Claus. We're just trying to deliver some wholesome financial content. But I get your point, and without further ado, and a friendly reminder, this is not financial advice. Here are 10 stocks that might be worthy of your consideration for your Christmas list.
Number 10!
Wait, sorry, are you saying this, or?
What? I thought we were gonna count down together. Your ego is bigger than Santa's.
No, absolutely, we'll do it together. So number 10, and we'll do this in alphabetical order, is
Apple. Now the stock is pricier than the S&P 500 itself, but analysts like it and it's been a rock star with return on invested capital. Okay, Johnny, you say number 9.
That would be Bath and Body Works, which hasn't been as consistent as Apple with return on invested capital, but it's been solid. Analysts on average like the stock, and they see free cash flow increasing by more than 40% over the next 3 years. Over to you, Mrs. Claus.
Well, Johnny, it would have been nice if you bought me something from Bath & Body Works because I really like that warm vanilla sugar spray, but I guess you're too cheap. Anyway, moving on to number 8. Decker's Outdoor, home to UGG and Hoka. It has a solid capital track record, and Wall Street sees free cash flow rising more than 40% over the next 3 years.
Okay, number 7 is the defense giant Lockheed Martin, which is expected to see, on average, less free cash flow growth than some of the other companies we're talking about over the next 3 years, but it has been a very steady performer when it comes to notable return on invested capital performance.
Number 6, home retailer Lowe's. Just like Lockheed Martin, it's expected to see less free cash flow growth than other companies on this list. But it has proven to be a very savvy allocator of capital.
Number 5 is another retailer. It's the yoga wear maker Lululemon, which met all of our return on invested capital requirements and is expected to see free cash flow growth of more than 30% over the next 3 years.
Okie dokie, number 4. MasterCard made the cut. The stock is pricier than the S&P 500. But this company has really nailed return on invested capital. Wall Street loves the stock, and free cash flow is expected to grow more than 35% over the next 3 years.
Okay, number 3 on our list, and just a reminder, this list is just based on alphabetical order for the names, is NVIDIA, which is arguably one of the most talked about stocks of the year. And it is a stock that looks pricey when you compare it to the average company within the S&P 500 measured by PE ratio. But on average, analysts still really like this stock. About 90% of them are still recommending it, and free cash flow is expected to grow by about 85% over the next 3 years.
And our second last stock is a rival to MasterCard. A lot of people are using it this holiday season. Visa. It's an analyst favorite on Wall Street, and free cash flow is expected to rise more than 20% over the next 3 years.
And the final stock on our list is Wingstop, the wing chain. Now, the shares have had a huge move over the last 5 years, so analysts are now a bit more mixed on the outlook. However, Wingstop has proven to be an efficient allocator of capital, and on average, analysts are expecting the company's free cash flow to increase by more than 70% over the next 3 years. So that's our list of stocks. And Mrs. Claus, I know it's a busy time of year for you, and you wanted us to get all this wrapped up, no pun intended. Nice rapping skills there, Mrs. Claus.
I said a hip, hop, hip it to the hippity and don't stop the rock.
Nicely done, Mrs. Claus. Thanks for watching. Thanks, Mrs. Claus. Thanks to MarketLabNewsletter.com for all the graphs in our video. What stocks are on your Christmas list? Let me know in the comments, and don't forget to subscribe so you don't miss our next investing video. Happy holidays. See you next time.